Imagine you started your investment career with just rupees 5,000 and in the next 35 years, your portfolio has compounded to $4 billion. Now this is the real story of a real legend who is Mr. Rakesh Jhunjhunwala. Around third of his portfolio consists of a company called Titan, which when he had identified was a small cap company with a market cap of just 500 rupees crore. Welcome to Swatantra. Today we are going to talk about small cap investing. So coming back to the Titan story, here's what happened. So this was a time in 2003 when Indian markets were in a bear market phase. A broker had called Mr. Rakesh Jhunjhunwala and he was desperate to sell his shares in Titan. So he had quoted for 10 lakh shares, the price quoted was 50 rupees. For 20 lakh shares, the price quoted was around 35 rupees, and for 40 lakh shares, the price quoted was around 33 rupees. So clearly, the broker was in a desperation to sell, and this is when Rakesh Bhai had bought these shares. So the idea here was, or even which another legend shows, is that invest first and investigate later. So Rakesh ji had first bought the shares and later he went and met the management of Titan and understood more about the business. His rationale of buying Titan was very simple. The margin of safety was very high since the market cap was only 300 to 500 crores, and Titan, which is a Tata Group company, the chance of it going into default or not performing good was very low. So here are two key lessons which we learn in small cap investing. First, you have to build in a strong margin of safety, both in the price and in the management. So there's no single definition to small cap. Every entity has its own definition. So for mutual funds, which is regulated by AMFI, the first 100 companies are considered as large cap companies. The 101st company to the 250th company are mid cap companies, and all the other companies are considered to be small cap companies. So for us, how we personally segregate companies which have a market cap above 50,000 crores are large cap companies. Companies which have a market cap between 50,000 crores and 10,000 crores are mid cap companies. And small cap companies for us are the companies which have a market cap below 10,000 crores. Also, we've spoken to some foreign investors, and since these guys manage money in a very huge quantum, for them small cap is anything below approximately $5 billion or approximately 40,000 crores. So small cap investing is similar to venture capital or PE funds. So in a portfolio of around 10 companies, 2 or 3 companies are going to make it huge, and your major portfolio returns are going to be generated by these companies. So in the past, there have been many multi-baggers which initially started as small cap companies. So the first example is Bajaj Finance. So this has been a 1000x bagger since 2008 to 2022. Also, it's not just that the stock price has compounded or the stock has gone 1000x, the business has also delivered quite well. So in 2010, their loan book size was just 1000 crores, and now the loan book of Bajaj Finance stands at around 2 lakh crores. So this is where huge money is made, and small caps can truly transform into mid or large cap companies when the opportunity size is huge. The second example is Eicher Motor, which manufactures one of the most iconic and the oldest motorcycle brand, which is the Royal Enfield. So in 2006, this company was just selling around 33,000 bikes per annum, and in 2018, they peaked at around 8 lakh bikes per year. So this is where you can see that just as the business compounded, as their sales compounded, even their stock multiplied, and even Eicher Motors was a 127x multi-bagger. Also, small caps are quite cyclical. So the BSE Small Cap Index was trading at around 14,000 in 2008, and in 2009, post the mortgage crisis, the index was down to 3,000. that was a quite significant fall. Similarly, in 2018, the small cap index peaked at around 20,000 rupees, and in 2020, just after COVID, the index had dropped to a level of 9,000 rupees. So overall, small cap investing is quite cyclical, but if you look at the long-term returns, where we compare large cap mutual funds and small cap mutual funds, the median returns of small cap index funds is around 18% compared to the median returns of large cap funds, which is just around 12%. So in the long run, small caps are expected to deliver higher returns as we take slightly higher risk. So one reason why I like small cap companies is that there are many small cap companies which are into very niche segments or industries which are not available in the large cap space. So for instance, there's a company which is into textbook publishing. So now recently the government has decided to change the syllabus of NCERT. So this is the one company which can benefit humongously, as all the old and second-hand books would flush out of the system and they would see a rise in sales in the near future. Secondly, there's also a company called Garware Ropes, which is into the manufacturing of specialty ropes. They manufacture ropes which is used in fishing. Also, they manufacture ropes for various sports tournaments, like it's used in tennis or badminton or even in the Barclays Premier League. Also, around 10 years earlier, there wasn't a single specialty chemical company in the mid or large cap space. But now, since this sector has done quite well over the last 3-4 years, especially because companies are looking as an alternative to China, many companies have emerged in this space, and now we are seeing specialty chemical companies in the mid cap and large cap space. So I think it's a very important to have certain allocation to small caps to get some exposure to certain industries which are not available in the large cap space. Secondly, in small cap investing, since these companies have a very small base, it is very easy for them to grow on a very smaller base. Let's say a company which is doing a revenue of just 100 crores, for them is easy to get the next 50 crores. But for a large cap company which has a revenue base of 10,000 crores, it's very difficult for them to grow by 50% in a single year. And in the long run, the percentage growth you bring in your profitability is strongly correlated with the percentage growth in the stock price. So growing on a smaller base helps you a lot, and that helps investors compound their money faster. Secondly, small cap investing, since these companies are undiscovered, they trade at a very low valuation, which can be a very significant head start for investors, as your margin of safety is very high since you're buying these companies at a very low valuation. And one reason why these trade at a very low valuation is because they are undiscovered, and they are not owned by prominent mutual funds or prominent foreign investors. So as these companies get discovered, as brokers and analysts start tracking these companies and share their research reports, these companies get into the fame, and as this happens, the stock gets re-rated. So this is another reason why once the re-rating happens, these companies get higher multiples, which help accelerate your returns. Thirdly, smaller companies have an optionality. So let's say a small chemical company can just focus on a very high margin chemistry or high margin products where the volume is low and the per kg EBITDA or the per kg revenue is very high. But a large cap company, since it has a very huge base of, let's say, 5 to 6,000 crores, it cannot go after a very small segment which will just add 100 to 200 crores revenue on its base, even if it comes at a significantly higher margin. So small cap companies can be very selective when they want to identify a niche product line or a niche chemistry for chemical or pharma companies. And lastly, what we've seen in our personal career is that M&A or merger and acquisition can play a significant role in the long run for small cap companies, as M&As usually add a lot of value in smaller companies when they have a smaller base. So there are companies like Infobeans where just one acquisition added around 22% of inorganic growth in the first year itself, apart from the 25 to 30% organic growth this company was having. Similarly, a company called Affle, which we'll discuss later in more detail, their organic growth target was always 35%, but because of acquisitions, they were able to achieve an total growth of around 65% since listing. And 65% growth is exceptionally high. It's almost equivalent to three fast-growing companies of 20%. So M&A can play a very huge role in small-cap companies, and this can help investors achieve the returns which were expected in 10 years in just 2 to 3 years. So there have also been many demerger stories where these companies, after they were demerged, have created significant wealth. So for instance, Greenply Industries had two demergers. The first one was Green Laminate, which was their laminate and decorative business, and the second one was Green Panel, which was majorly their MDF business. So what happens after a business is demerged? Typically, since the demerged entity falls into the small cap category, many institutions and domestic mutual funds are forced to sell these companies regardless of whatever valuations they trade at, because they have a mandate that they have to buy and hold companies which are above a threshold market cap. So because of this, many investors get opportunities to buy these demerged companies at very attractive valuation. Similarly, KPIT, which is a automotive ERD company, was demerged from Birlasoft, and after this demerger, investors could get a good company, one of the only listed companies in the automotive ERD space, at a very low valuation. And another benefit of this is that whenever an entity is demerged, the promoters have already created a track record. So it's not that you have to go and study about the business or about the promoters. Since the promoter track record is already there, there's a huge assurance for investors that these businesses are managed by great promoters and they would do quite well in the near future. So the company we are going to cover is called Affle India, which is into the digital marketing space. So as a view, we have a structural view that advertising as a segment is going to grow drastically over the next decade. But moreover, the pie of digital advertising is going to grow at a faster rate, and we believe that print would decelerate after a certain time. So, and post-COVID, what we realized that the rate at which this was happening was humongously fast. And Affle was at the right time, at the right place, with very strong tailwinds. So the industry itself was growing at 25%, and historically, pre-IPO, Affle was growing at around 35%. So what we realized here that if you can identify a company with a strong promoter, a promoter who has a track record of execution, with good financials, and a spark of entrepreneurship and quality to scale a business, these are the ingredients of a multi-bagger stock. So if you look at the returns of Affle, it has gone up around 6 to 7x. So it listed at around 168 rupees, and currently it is trading at near about 1250 rupees. Also, what we realize is that it's very easy to read numbers for small cap, but the challenge where investors face is that studying about the promoter and about the business is very difficult, because mostly small cap companies do not have con calls or PPTs, and even the managements are not accessible as compared to larger companies. So in Affle, what we studied is that the entrepreneur, Mr. Anuj Khanna-Soham, who is the founder of the company, has a very strong entrepreneurship attitude. So when he moved to Singapore to study for his graduation, he started two companies earlier before he started Affle. And at that time he actually wanted to work, but on a student visa it's not allowed to work, and he found a loophole where he could form a company, be a foreign director, hold shares and work for a business without drawing a salary. And even today, if you look into the annual report of Apple, Anuj Khanna Soham draws a mere salary of just 20,000 rupees per month. It really tells you more about the promoter, that he's not here in for the money, but he's here to make a huge business. Now, coming to the business model, what we realize is that most of the digital marketing companies, the way they work is that they tell the customers that we'll do ads for you in so and so format, and we'll charge you so and so format for these ads. But there is no guarantee that we'll drive X amount of business for Y amount of money. So this is where Apple realized that a good business model could be built where both the customer and Apple benefit through it. So Apple came out with a CPCU model, which is a cost per converted user. Now let's say one of their largest clients in India is Amazon India. So Apple would run ads for Amazon India, but Apple will only earn money whenever a user is converted. So a user can be converted whenever an item is added to a cart or whenever a purchase is made from the cart. So this is a win-win situation for even the end customer, which is Amazon, and even for Apple. So this actually we believe is a very strong moat, and they have been growing this business both domestically and internationally. And apart from this, they initially had a guidance of 35% growth. Organically, they've been growing at around 40%, but they've also done around 4 acquisitions, which have helped them grow inorganically, and their total growth since the IPO has been around 64 to 65%. So if you're able to identify such companies beforehand, which are able to grow at 60% plus, wealth creation is guaranteed in such scenarios. The most important thing, which I believe, is holding these companies and not selling them too quickly. A 2-3 bagger, everyone likes it, everyone likes to see money is being made, but one should always reevaluate their principle or their thesis, because these same companies can go on to be 30 or 40x baggers. Many investors I've seen that they hold a very concentrated portfolio, and when the tide turns and since even small caps have a very low liquidity, the drawdowns are much sharper, they lose their patience. Also, we've seen many investors hold on to their investments regardless the fact that they know that the company is not working well, or either the promoter is defrauding the company. So there's a case where one solar company which had IPO'd around 2 years earlier, they had promised the investors that they would be raising money from the IPO investors and repaying their debt. But after they received the money, they transferred the same into another account. So always one has to be conscious about the investor, and here managing your weights is very important. Also, what we've seen is that many promoters here overcommit and underdeliver. They set out huge targets which they internally know are not possible, but they give them for various reasons. So recently we met a solar company which had just ventured into the EV space, and at the beginning of the PPT they compared themselves to Tesla, and the promoter compared himself to Elon Musk. So according to us, these are red flags. So we prefer companies where the promoters are going to over deliver and under promise. So what we've learned is that this is a secret sauce in small cap investing. Also, apart from that, one should always reconsider their investment thesis as you get new information. Also, investors should reconsider their thesis whenever there is new data, and they shouldn't be anchored to their buy price or their historical or their older opinion. So if you take the example of Titan, which we discussed earlier, since Rakesh Jhunjhunwala had held the stock for more than 20 years, he knew every piece of the business and the industry. So this was a huge competitive advantage for himself, and I guess there is no other investor who would have better knowledge regarding the stock and the company than Mr. Jhunjhunwala. So I believe like one shouldn't just sell it because the stock has gone 2x or 3x. It could be a 10x or 20x. Also, if the opportunity size is large, these companies keep compounding at a rapid pace. For instance, if we look at Bajaj Finance, it has still been able to deliver even after it has become a mid or large cap company. Also, I feel that once the story has played out for the company, and if you expect incremental returns from here on to be just 15-20%, you could just exit the company and reduce your risk, because if you want to earn 15 to 20%, you're better off in investing in large cap companies like HDFC Bank or TCS, where the return expectations are lower, but even the risk is much lower than staying invested in a small cap company. If you've liked this video, hit the like button and subscribe now. Also, you can just share this video with 5 of your friends who you think would like to know more about small cap investing. Standard disclaimer, this video is just for educational purpose. None of the stocks discussed here are recommendations.